Today, we will discuss strategies for legally reducing federal estate tax liability. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, commercial, and estate planning law throughout the states of Florida and Texas. I'm Chief Executive Officer of the firm Cummings and Cummings Law, and I also teach business law at Florida Gulf Coast University and hold a variety of tax, financial, and accounting credentials, which I apply in my law practice for the benefit of my clients. Our firm website is www.cummings.law, not .com, but .law. The estate tax, sometimes comedically referenced as the quote unquote death tax, is a levy or imposition on the transfer of the estate of a deceased person. It is crucial to understand that this tax is imposed upon the estate itself, not upon the heirs or beneficiaries receiving the inheritance in most cases. Many individuals mistakenly assume that estate taxes apply only to the very wealthy, but this is not always the case. The threshold for estate tax liability can vary significantly, and it is important to be aware of the specific exemptions and rates applicable in your jurisdiction and tax year. Estate tax planning is a complex area of law that requires a comprehensive understanding of both federal and state regulations. Engaging a qualified and experienced attorney and CPA is essential to navigate the intricacies of estate tax law and to develop a tailored, bespoke strategy that potentially minimizes tax liability when implemented correctly and consistently. The interplay between federal and state taxes, as well as the potential for changes in legislation, as we just saw with the enactment of the so-called One Big Beautiful Bill Act, makes professional guidance absolutely indispensable. One effective strategy for reducing estate tax liability is to avail yourself of the annual gift tax exclusion amount. The Federal Internal Revenue Service allows individuals to gift a certain amount each year to any number of recipients without incurring gift or estate taxes. By systematically gifting assets, which could be money or other property, every year, individuals can reduce the overall size of their estate, thereby potentially lowering and in some cases even eliminating estate tax liability altogether. It is important to understand that the annual gift tax exclusion applies per recipient, which means that a married couple can collectively double their annual gift to each recipient without incurring additional gift or estate taxes. This strategy requires careful planning and consistent documentation to ensure compliance with IRS regulations. Misunderstanding the nuances of gift tax rules can lead to disastrous unintended tax consequences, further underscoring the importance of seeking advice from an experienced attorney and CPA. An irrevocable life insurance trust, or ILIT, spelled ILIT, is a sophisticated, advanced estate planning tool designed to exclude life insurance proceeds from the taxable estate. By transferring ownership, and it's really quite broad, but we'll just call it ownership for now, of a life insurance policy to an ILIT and ensuring consistent observance of all of the formalities that go along with the administration of an ILIT, the proceeds will not be considered part of the estate upon the insured's death. This can significantly reduce estate tax liability, especially for individuals with substantial life insurance policies. Creating an ILIT involves complex legal and financial considerations, including the irrevocable nature of the trust itself, as well as the requirement for the trust to be both the owner and also the beneficiary of the policy. The trust must be carefully drafted to comply with the Internal Revenue Code and Treasury regulations, as well as applicable case law. And any missteps can result in the inadvertent and undesirable inclusion of the life insurance proceeds within the taxable estate. Professional guidance is essential to ensure that the ILIT is properly established and administered on an ongoing basis. The marital deduction is another powerful tool in estate tax planning, which allows for the transfer of an unlimited amount of assets between spouses, as long as both spouses are US citizens, without incurring estate or gift taxes. This deduction effectively defers the estate tax liability until the death of the surviving spouse, thereby providing an opportunity to implement further tax planning strategies during the lifetime of the surviving spouse. While the marital deduction is a valuable mechanism, it is not without its own complexities and pitfalls. It is crucial to consider the implications of the surviving spouse's estate tax liability and the potential impact on heirs and beneficiaries. Additionally, the use of the marital deduction may necessitate the creation of what is known as a qualified terminable interest property, or QTIP or QTIP trust, to ensure the proper distribution of assets. Engaging an attorney and CPA can help navigate these intricacies and optimize the use of the marital deduction. A family limited partnership, or FLP, is an estate tax planning vehicle that allows families to consolidate assets and transfer wealth to future generations while maintaining control of the assets. These are very often used in the case of close family held businesses. By transferring assets, which may be shares of stock or membership units in an underlying operating company, into a family limited partnership, individuals can take advantage of what are known as valuation discounts for lack of marketability, as well as minority interest discounts, thereby potentially reducing the taxable value of the estate. Establishing a family limited partnership involves intricate legal and tax considerations, as well as practical considerations, including the drafting of partnership agreements, buy-sell agreements, push-pull agreements, written consents, several other documents, not to mention compliance with IRS regulations. The structure of the family limited partnership must be carefully designed to achieve the desired tax benefits while avoiding potential pitfalls, such as challenges or scrutiny from the IRS regarding the legitimacy of valuation discounts. Professional assistance is crucial to ensure the successful implementation of any FLP strategy. Charitable giving can be another effective strategy for reducing estate tax liability while simultaneously supporting philanthropic causes. By making charitable donations during one's lifetime or through the application of a charitable remainder trust, or CRT, individuals can potentially reduce the size of their taxable estate and potentially qualify for income tax deductions. Charitable giving strategies require careful planning to align with personal and financial goals and tax objectives. It is important to consider the timing and structure and vehicle of charitable deductions, as well as the potential impact on heirs and beneficiaries. An attorney and CPA can provide valuable guidance in developing a charitable giving plan that maximizes tax benefits and fulfills these intentions. Portability of the estate tax exemption is another aspect we should consider. Again, it's called portability. Portability allows a surviving spouse to utilize the unused portion of the deceased spouse's federal estate tax exemption. This provision can effectively double the estate tax exemption available to a married couple, providing significant tax savings opportunities. To take advantage of portability, the executor of the deceased spouse's estate must make an election on a timely filed federal estate tax return. This process involves meticulous attention to detail and adherence to IRS filing requirements and strict deadlines. The complexity of portability rules necessitates the expertise of an attorney and CPA to ensure compliance and to optimize the value of the tax benefits derived therefrom. As you can see by now, reducing estate tax liability is a multifaceted endeavor that requires a comprehensive understanding of tax laws, financial strategies, and legal instruments. The inherent complexity of estate tax planning further underscores the necessity of engaging a qualified and experienced attorney and CPA who can work together as a team and provide expert advice tailored to individual circumstances. Common misconceptions and oversights in estate tax planning can lead to significant, undesirable, and in some cases, irreversible financial and legal consequences for heirs and beneficiaries. By proactively implementing effective strategies and seeking professional guidance, individuals can optimize their wealth and potentially preserve it for future generations while minimizing estate tax liability. There's much more to discuss, but that's about all we have time for today. Again, my name is Chad Cummings of Cummings and Cummings Law, and it was a pleasure sharing this information with you today. If you have any questions regarding this or any of the other topics covered in my videos, please visit my firm website at www.cummings.law, again, not .com, but .law, to schedule a telephone consultation. Thank you for your time, and I look forward to the opportunity to speak with and perhaps even work with you very soon.